Let that sink in for a second. 93.319, that's what silver closed at during the afternoon trading session on the Shanghai Futures Exchange today. Not last week, not yesterday, today, January 12th, 2026. And the difference between these two prices? The gap between the made-up New York price and the real Shanghai price? It's now $8.31, $8 on a single ounce of silver. In a normal working market, that gap shouldn't last more than 5 minutes. Every trader looking to make easy money would be snapping up silver in New York at $85, shipping it to Shanghai, and flipping it for $93. They'd pocket an $8 profit on every ounce with zero risk. They'd close that gap within hours. But the gap isn't closing. Actually, it's getting bigger. And why it's growing is the most crucial thing you need to grasp about the silver market right now. The arbitrage game is dead. The connection between East and West has been severed, and the metal that used to move freely between these markets isn't flowing anymore, because there's no metal left to ship. This is the moment we've been sounding the alarm about for years. This is when the paper market collapses. This is when the whole system cracks, and you're witnessing it unfold live. Let me break down exactly what went down today, because the numbers coming out of China are absolutely wild. The Shanghai Futures Exchange runs silver trading in 2 sessions, the morning AM session and the afternoon PM session. This morning, the AM session wrapped up at $91.13 per ounce. That was already huge. Way higher than the US spot price, though we've seen Shanghai premiums before. So while it caught our attention, it wasn't totally shocking. But then the PM session happened, and everything changed. The afternoon session kicked off, and the buying pressure was intense. Not just small-time retail folks or speculators either. Industrial buyers, corporate purchasing managers, strategic orders. They were scooping up everything available at whatever price. By closing time, the price had rocketed to 93.31. That's a 218 jump in a single afternoon. That's the kind of move you see during a currency meltdown. The kind of move that happens when a government loses grip on its bond market. But this isn't currency. This is actual physical metal. And the fact that it's jumping $2 in one afternoon tells you these buyers are frantic. Now let's look at what happened stateside today. The COMEX spot price for silver, the price you see on every financial news channel, every broker platform, every investment app, closed around $85. I say around because it's bouncing around minute by minute. But here's the key. The US market is trading at least $8 below the Chinese market. $8. That's not a premium. That's not a spread. That's a canyon. In the commodities world, an $8 gap on something as standard as silver means market failure. It means these two markets aren't connected anymore. It means the price discovery system has broken down. It means we're not dealing with one global silver market anymore. We've got two separate markets that don't relate to each other at all. And here's the scariest part. The gap isn't shrinking, it's expanding. 2 weeks back, when we started tracking this after China launched their export licensing system on January 1st, the spread was around $5. Last week it grew to $7. Today it hit 8.31s. What's that tell you? The pressure's building, not easing. Every day that passes, Chinese buyers are willing to pay more and more above the Western price. They're not waiting for prices to line up. They're getting ahead of the inevitable Western market breakdown. Why pay $93 when the spot price is $85? Because they know the spot price is meaningless. The spot price is what you pay for a paper promise. It's what you shell out for a futures contract that might or might not actually deliver metal in 3 months. But the Shanghai price? That's the price for real physical silver bars you can touch. Metal you can load onto a truck and haul to your factory. And in a world where the vaults are empty and delivery failures are stacking up, the physical price is the only one that counts. So when I tell you silver hit $93 in China today, I'm not talking about a rally, I'm talking about a repricing. The market is finally, after decades of being held down, discovering what scarce physical metal is really worth in a world that desperately needs it. Which brings us to the question everyone's asking. Why can't arbitrage traders close the gap? Why aren't the banks buying in New York and selling in Shanghai? The answer is simple and terrifying. Because there's no silver to move. See, arbitrage needs two things. First, you need different prices. We've got that. The spread is $8. Second, you need available supply. You need to actually buy the metal in the cheap market and haul it to the expensive one. And that's where everything's falling apart. When banks try to buy physical silver in New York, when they try to take delivery from COMEX, when they try to get bars from dealers, when they try to pull metal out of vaults, they're finding out the metal isn't there. The registered inventory at COMEX is down to around 30 million ounces. Sounds like a lot until you realize the open interest, the total paper claims on silver, represents hundreds of millions of ounces. So the metal that's supposed to back all those paper claims doesn't exist. It's been drained, pulled out by smart money who saw this coming months ago. And even if a bank could find silver in New York, they can't ship it to China because of the export licensing system. Once metal crosses into China, it's stuck there. It can't come back out. The Chinese government basically created a one-way door. Silver flows in, but it doesn't flow out. So the arbitrage isn't just tough, it's impossible. The bridge is destroyed. The two markets are now floating separately, totally disconnected. This is the split we've been talking about for weeks. And today's the day it became undeniable. Now you might be thinking, okay, so the Chinese are paying extra. So what? I buy my silver in the States. Let me explain why this matters to you, because what's happening in China today is a preview of what's about to hit the United States. The Chinese market is the early warning system. It's the canary in the coal mine. And the canary just keeled over. When Chinese buyers are willing to fork over $93 while the paper market says $85, it means the paper market is mispricing the asset by $8. And eventually, the paper market has to correct. It has to catch up to reality. How does it catch up? Through a delivery squeeze, through a default, through a force majeure declaration, through one of a dozen different ways that all end the same. The paper price explodes upward to meet the physical price. And when that happens in New York, when COMEX is forced to admit it can't deliver the metal being demanded, the US price isn't going to drift slowly from 85 to 93. It's going to gap. It's going to open at 95 or 100 overnight. Because once the illusion of the paper market shatters, the real price shows itself. And the real price is whatever desperate buyers will pay. So, the Shanghai price today isn't just some foreign market oddity, it's a prophecy. It's showing you exactly where the US price is headed, and it's giving you a very small window to prepare. But the Shanghai price is just one piece of the puzzle. While I was watching the Chinese market shoot up today, I was also making calls. I was talking to people inside the physical silver industry here in the US, and what they told me should scare everyone watching this. I spoke to executives at major bullion dealers, not little mom-and-pop coin shops, the biggest dealers in the country, the ones supplying the retail market, the ones with connections to mints and refineries. And they told me straight up, nobody has any silver. Those were the exact words. Nobody has any silver. The premiums, the extra amount you pay above spot price to actually get physical metal in your hands, exploded today. Premiums that were $5 last week are now $8 to $9. And that's just the starting point for haggling. One executive told me, and I'm quoting directly, silver round premiums could go to $20 to $30 per ounce here, $20 to $30 on top of an $85 spot price. That would put the actual cost of buying a silver round at $105 to $115. And he wasn't guessing, he wasn't exaggerating. He was looking at his inventory sheets and order backlog and telling me what the math says. Here's the reality. The private mints that make silver rounds and bars for everyday buyers are completely swamped. The orders they've gotten in the last 2 weeks have blown past anything from the 2020 silver squeeze, and back then they managed to ramp up production and catch up within a few months. But this time's different. This time they can't get the raw material. The refineries aren't selling to them. Refineries are prioritizing their contracts with industrial users. The Teslas, the Apples, the solar panel makers, the mints are at the back of the line, so delays are exploding. Order a silver round from a private mint today, and you're looking at an 8-week wait. 8 weeks, 2 months. And that's assuming the mint doesn't run out of silver completely and have to refund your order. Think about what that means. If you want to buy physical silver right now, you've got 2 choices. Option 1, buy from a dealer who has stock and pay an insane premium. Option 2, place an order with a mint, wait 2 months and cross your fingers they can actually fulfill it. Neither's great, but option 2 is basically gambling. You're betting the system holds together 8 more weeks. You're betting the mint can source the silver. You're betting the price doesn't explode to $150 while you're waiting. So if you want silver, you're gonna have to pay the premium. There's no way around it. The spot price on your screen is fantasy. The real price, what you actually pay to get metal, is already pushing $100. And this brings us to an uncomfortable truth most investors don't want to face. The price you see on TV isn't the price of silver. It's the price of a derivative of silver. The price of a futures contract. The price of an ETF share. The price of a paper promise. But when you try to convert that paper promise into actual metal, you discover the exchange rate isn't 1-to-1. You discover the paper says $85, but the metal costs $100. This is the paper to physical premium, and it's exploding right now. Why? Because dealers aren't stupid. They see what's coming. They see the same data we do. They see the Shanghai price, the delivery failures, the COMEX inventory drain, and their pricing in the future. They know the silver in their vault today will be worth way more next month. So why sell it to you cheap? They're holding out for the higher price, rationing their inventory, waiting for the spot price to catch up to physical reality. And when the spot price does catch up, when COMEX finally admits the paper market is broken, the dealers who held their stock are gonna make a killing. They'll sell their silver at $120 or $150. They'll look like geniuses. But the investors who waited? Who believed the spot price? Who thought they could buy the dip when silver pulled back to $75? Those folks are gonna be left with nothing, because by the time they try to buy, the metal will be gone. This is the supply shock we've been warning about, and it's here. Not coming next year, not coming next month. Here today. Now let's zoom out for a second and talk about what this means for the broader financial markets, because the silver squeeze isn't happening in a vacuum. It's happening at the exact same time as a historic move in gold. Gold hit an all-time high today, somewhere north of $2,600 per ounce. That's a massive breakout. That's gold screaming that something is very, very wrong with the global financial system. And when gold and silver both rip to all-time highs at the same time, it's not a coincidence. It's not just a commodity rally, it's a signal. It's the market voting with billions of dollars that the fiat currency system is failing. Now here's the part most people don't get. When gold and silver go vertical like this, they don't just pull money from stocks or compete with stocks for investor cash. They do something way more destructive. They create a liquidity black hole. Let me explain how this works.